Hey, welcome back, investor. We've got another event for you today. We have these every 2 weeks, every Thursday. We either do a lunch and learn, like at the time that we're doing it right now, or we are doing it in the evening. So we've got a webinar coming up that we wanted to mention. It's easy to go and sign up to be getting calendar reminders for our webinar, risecapitalinvestments.co/webinar. And you can sign up there and it'll talk about what it's about. So this month, we're basically talking about how to do a self-directed IRA, why you would want to use one, when they're appropriate, when they're not appropriate for different kinds of investments. And we're going to have a specialist from Directed IRA coming in to talk to us, Nate Hare. And we have a discount that you can use for your first year. If you end up signing up with Directed IRA, we do not get any referral fee for that. It's just a discount that we've negotiated for you from Directed IRA. So without further ado, my partner, CEO of Rise Capital, Chris Borden, in the house today. Hello, Chris.
Well, first off, I didn't know it was lunch and learn, so I don't have lunch in front of me. We'll just go with water.
I'd show you what I have for lunch, but you know I eat weird stuff, so I'm not going to make that public. Yeah, well, so I wanted to introduce the webinar by talking more about a little bit more broadly about retirement accounts and cash versus retirement account investing. I got a really great question. I actually get this question kind of a lot from potential investors, but it happened again this week. Somebody saying like, "Hey, I'm 48 years old. I have a lot of money in my retirement accounts, and I don't want to invest anymore in there because I want to retire when I'm 50 or 55, and I want to make sure that I can live for that 4, 5, 10 years." Before I can access my retirement accounts. And it kind of got me thinking like, well, we're talking about self-directed IRAs and how they have great tax benefits for our investors who are loaning money, and they're getting taxed on that money as active income, and yet they want to retire early. So in order to protect it from the taxes, they want to put it in a retirement account. But in order to retire early, they have to have it out in a cash account so they can live off of it during that time. So we were talking about other tax mitigation things that they could do and all of that. So kind of got my mind thinking as we're coming up with a self-directed IRA, when is it a good idea? When is it a bad idea? When is investing in an IRA a good idea? And when is investing with cash a better idea? And I always say there are no solutions, there are only pros and cons. So let's just talk about the trade-offs of each and kind of lead up to what we're both doing. So I wanted to start by asking you, like, tell me about what's in your portfolio, like what happened, because we no longer have 401ks because we no longer have jobs. But what happened to your 401k after you left the job? And how did you diversify out in and outside of your own retirement accounts?
Well, it multi-layered, multifaceted, I would say.
Diversification means multi-layered and
Well,
multifaceted.
normally when you leave a company or a job, normally that you have to do something with that 401k or IRA, depending on how you have it all set up, or depending on what your company has. So throughout my career, while I really only was in a few different industries, but primarily in one industry, I did go through several mergers and acquisitions, and I was on both sides of the spectrum. So even when you go through a mergers and acquisition, normally you don't have the company that's picking up normally has their own 401k or retirement account. It depends.
Mm-hmm.
Actually, before I left, I had a deferred retirement account. It wasn't a 401k or an IRA, slightly different, and it's based off of income. And at the time, I was a high income earner, so it wasn't necessarily qualifying for your typical 401k retirement account, because even at that, you can only make so much and put so much into the retirement accounts before you have to look at different strategies. But throughout my career, I had to roll over in the beginning portion of my career. I think it was like, maybe this is pretty atypical, but I moved it over to a financial planner. And my financial planner was basically managing, and he diversified strictly on the equity market. And then shortly after retiring, we'll say
Retiring.
air quotes, yeah, retiring. I moved all of my money over to a self-directed account, and I was self-directing all of the retirement. I mean, all of the proceeds that I had there. Most of it was directed primarily into real estate. And even that I diversified. So I diversified between equity and debt. So I preached this before. I treat my portfolio like a sort of like a financial planner would treat it, with kind of diversifying. So
Mhm.
we diversify geographically on our equity investments, and then I diversify between equity and debt. I have about, I have to go look. I don't know the exact number. I'll just say round it off to somewhere around 60 to 70% of my portfolio is in debt investments. Again, you're just looking at the risk return profile of it. But I also have money that I invest in the equity market. So I self direct a certain portion of it into, specifically into the equity market on different stocks that I feel have longer growth potential. So that's
Mhm.
kind of my current portfolio in a nutshell.
Yeah. It
I'm assuming you're pretty similar. So maybe tell us a little bit about your portfolio.
Yeah, well, I mean, for those of people who've known me for a while, like I've never had a W-2. So I've either been 1099 contractor, self-employed, or stay-at-home mom. And I'm trying to think if I've ever had a job where I got a W-2 piece of paper. Um, it's all been contract work and serial entrepreneur. But my husband has had W-2s pretty much our entire marriage until just the last 2 years. So I can tell you what we did with my self-employed and also with his 401k. So most of the time he was working for startups. He's a startup specialist, does IT. So he's like employee number 4. There's no 401k, right? And so he oftentimes didn't have any 401k or sponsored work savings at all because they just didn't have it set up. Like you mentioned with the mergers and acquisitions, smaller companies often just can't afford a match, they can't afford the fees, so they just don't do it. So as a company got larger, every time he would be in a startup, they would introduce a 401k, and we would just put in the money that was the company match. Their portion went into a traditional IRA, their match portion went in, but we elected to have our portion go into a Roth IRA. So it's a 401k, meaning it's a work employee sponsored plan, but they follow the same types of accounts that you can get. Usually it's a traditional IRA, pretty much only. But they did add the ability to do a Roth IRA. I don't know, it's maybe 10, 15 years ago. I can't exactly remember when, but you can't do things like a solo 401k or things like that. We would usually have a high deductible insurance plan as part of the benefits, again, because they're just trying to save money. And then when he was working for a healthcare data company, they were big on like being more transparent and more aware of your healthcare costs and why high deductible plans make you demand more price transparency in your care. And so that was kind of part of their reasoning for doing it. But we discovered the power of the HSA through that. So that we kept our 401k match in a traditional IRA, we kept our contribution in a Roth, and we kept a high deductible plan where we were putting the max into an HSA every year. And the company sometimes would match that HSA, sometimes they wouldn't, just depending on where they were in their growth cycle. So what ended up happening when he left a job, whether he moved to another job or the last time that he got laid off and he didn't go back to work, what we would do is we would roll over the traditional IRA into either we just had to get it out of the company plan because they only have like 4 mutual funds that you can pick from. We wanted more control than that. So we would just roll it over to like our Fidelity or whatever we were using, to just basically a traditional IRA that wasn't attached to the company. And then the Roth at that point, even before that point, from the 401k plan or the rollover plan, we can take out our Roth contributions at any time tax free. We already paid taxes on that money. And so if we want to take those contributions out and do something else with them, we could. Now, when we weren't diversified into alternatives like real estate, we just left the Roth contributions in there. We did pull some out to remodel a house. So I guess that was a real estate investment. It was our own personal home. We did a big gut remodel on it. That's actually the house when we sold it kind of funded our real estate business because we were renting when we relocated and we had all this pile of cash from the house. We didn't know where we wanted to live or what we wanted to do with that pile of cash. And so that's when we discovered real estate investing. And so what we ended up doing was pulling out some of that Roth money to remodel that house, that we sold in Texas. So that's basically what you do. You can roll it over. And then when he left his job in 2022, we just directly rolled it over to self-directed IRA from the 401k plan. So the other one, we rolled it over to traditional. And then later we're like, oh, self-directed, like created self-directed. And then when he left the second job, we rolled that 401k over into that same self-directed IRA. Now, it's important to understand the difference between like public equities and private markets. So, public equities are things like the stock market, bonds, mutual funds, things like that, traded funds, ETFs. Those are publicly traded, and that is what you're going to use in your traditional IRA. So, you're a self-directed alternative custodian or passive custodian, as they're called. They don't choose the investments. They don't tell you what to do. They just have it held there, make sure you're doing things legally, and they let you kind of invest in mostly whatever you want. There are a few restrictions there. So the difference between having a public equity and private equity, if you want private equity in your IRA, you must convert it to self-directed. You can invest in your friend's tech startup, you can invest in real estate, you can invest in crypto. Like, there are rules about what you can invest in, but for the most part, you can invest in whatever you want. But self-directed IRA custodians, I don't know of any. Maybe there are a few, but I don't know any who will allow public equities inside of a self-directed. So you keep your public stuff over here in your traditional custodian, and then you keep your private equity stuff or your private debt stuff over here in your self-directed IRA. And that's what we did with our accounts when he left his job. So now that you're retired, and we're retired, we're self-employed, or however we want to look at it.
Air quotes.
Yeah. Quotes. What does that look like for you right now, as far as what you do in cash and what you do in your retirement accounts? Because you are not 59 and a half. And so you have quite a few more years, that so do we, that to live off of our investments before we can access that stuff. So how do you balance that?
It is a balancing act. I was going to kind of ask you just kind of a similar question, and maybe we can have a discussion on it. Is like, why move from a regular, like, why go from an Edward Jones to a self-directed? I think that's probably an important underlying question. So what was the epiphany? Because you said it. Oh, I can move it over to a self-directed. What was that epiphany moment for you, and why did you move it over to a self-directed? And I'll kind of piggyback and say why we moved it over to a self-directed. I think it kind of ties into exactly what you're asking as well.
Yeah, well, it's basically like, what do we want in public markets and what do we want in private markets? I knew that people were investing in private companies with their retirement accounts, because some of the tech startups that he worked for, the founders were taking investments from self-directed retirement accounts. And I don't think at the time I got how that worked. I was like, oh, you can put your retirement account in there. Right. But then when I actually went to go try and do it, I realized I couldn't do it. And that because it was locked up in a company 401k plan. And so I thought that was why. But then when we rolled that over and realized we still couldn't invest in those tech startups with our retirement account because it wasn't self-directed. And I thought, oh, well, I thought it was self-directed. That's a colloquial term. It's not anything official in the financial world, because when I logged into my account, I had like 4 mutual funds I could choose from. So I thought that meant I was directing it. But when I realized it's more for private markets and those kinds of more self-managed types of decisions, that we had to pull some out of the public markets in order to get into the private markets. And that requires just a different structure of the way that the way that the custodian manages those funds. So that moment when we were like, yeah, let's go invest in this startup, really was what led us down that road. And then we finally did it when we discovered real estate. And I was like, oh, wow, we could do some damage between the money we made off of our house that we sold and part of what's in our retirement account.
Yeah, I think that kind of ties us into more of our journey as well. I think for the most part is we weren't getting the returns that we anticipated getting from our financial planner. And a lot of times, and it depends on the market, right? You're looking at this from a little bit longer term lens than you should be. I mean, you should look at short-term growth as well as long-term growth and strategize both ways. But I looked at on the short-term side, it looked good. I exited out when the market was relatively high. I pulled the majority of my money out of the equity market when the market was still high. But then I looked at for like a longer term horizon, and I looked at like a 10-year and a 15-year, and my returns were 5-6%. So they weren't great. So that was kind of like the nail that broke the camel's back, or the straw that broke the camel's back. Sorry, wrong phrase. Yeah. So I was like, no, I'm sure I can do better. Like I said it before, At the end of the day, no one's really going to care more about your money than you are. So
Mhm.
try and look to see how you diversify and how you're diversifying. So you talked a little bit about that, like how I manage. It is tricky. So there is some work that you have to put into it. But again, I mean, if you really want to expedite that wealth journey and your growth, then you should put in the work. And this is probably my fault for the majority of my career, because majority of my career was building companies that I worked for,
Mhm.
and I was damn good at it too. I mean, making them millions and millions and millions of dollars. And I forego it's just weird. I foregoed my own, and I gave it to
Yeah.
a financial planner because I assumed he knew better than I did.
No.
And that's, I mean, could be the case in certain areas, but again, I think more often than not, no one's really going to care more than you do about yourself. So
Yeah.
kind of look at it from that lens and understanding what you can do at your retirement versus what you're going to do with cash. I try to divert, like I said, we talk about diversification, but I try to diversify between my portfolio in my retirement accounts as well. And I manage both. So I manage an IRA as well as a Roth. It's okay having money in an IRA. You don't need it to have it all in a Roth. You just don't want your IRA to grow too large. You want your Roth to grow as large as it possibly can. You don't
Mhm.
want your IRA to grow. So it's a balancing act between how much income you have coming in as well to reduce your taxable liability there. And you can do that with a traditional IRA. You can't do that with a Roth because, like you said, you pay your taxes prior to going in. So it's this whole balancing act. And in a retirement account, depending on what retirement account, but most of them you can get taxed if you're picking up debt on the investments that you're doing. So the investments that I have in my retirement accounts, I try to pick up investments that don't have debt. Venture capital is one of them. Typically, they're not going to pick up debt. Sometimes they do, so you got to understand that as well. But I have venture capital, a few venture capital deals in there. I do a lot of debt deals in there as well, but I also do a lot of debt deals in cash
Yes, because we
because I
need the
want
cash
cash
flow.
flow. So it's just balancing where you're at in your journey and
Mhm.
just trying to navigate through the nuances of it. And there's a ton of nuances that you have to understand. But honestly, you spend a month reading some really good tax books,
Yeah.
really, and listening to several podcasts. You can get there. It's not, and spending a month to be able to diversify your portfolio, because I was getting 6% yields on a longer term horizon, and that's between mixed between both money market as well as equity. Now, just on the debt portion, I'm getting 10 to 12%,
Mhm.
and
Easily.
it's something that you could get as well in our fund and take. I mean, just basically doubling what I was be doing in a long term investment. So there's a lot of options out there. It's just you have to learn and kind of understand the nuances between all of them and how to manage cash on hand versus
Yeah.
IRA versus a Roth and HSA too. HSA is probably, I hear it a lot, tax-free growth. Really, the only one that you can actually get tax-free growth is your HSA, because it's, you don't tax going in, you don't tax going out, you don't tax on the growth. That's really the only account that you can actually get that's
Yeah.
tax-free.
I do really like that HSA and okay, so to back up, to be fair, we've never used a financial planner. I learned very early on in my stock investing career. I was probably like 10 when my mom told me that my grandpa was living on his retirement from his Air Force pension and from he she said he invested in the stock market and made $1 million. So at the age of 10, I was like, what's the stock market, right? How do you make $1 million and not have to work and live on that? So that was, but he was retired. That was normal. But for whatever reason, I got it into my head like, well, you don't have to be old to do it. I didn't know what that meant. So I started looking in the stock market very young, very early, and kind of playing around with that. And I learned one of the first lessons I learned was you can't beat the index unless you're some sort of a trading genius, which I'm not. And I didn't even really like it that much. And it was one of those things I always felt guilty I wasn't spending more time learning about. And then I realized like I'm never going to beat the index. So I just really stuck with the indexes because I didn't think that there was any point. And so what you have to understand is that private equity outperforms public equity on an index basis. And so that your index at your 6% over here, you just keep it in the index on those public, right? Because you can diversify across a broad range of companies and really just keep pace with that S&P. Whereas on the equity side, I knew that I needed to also index that by getting a wide enough variety of things that I could get those higher returns that private equities offer without taking the extra risk. It's kind of like buying single stocks in public versus only a couple of private things over here. That's why private sometimes seems more risky, is because we're not indexing it. We're not diversifying the same way we would in the stock market. So when I got into privates, I was like, I need to make sure that I spread it around and that I have a good management system, because sometimes it's annoying to track it all in different logins and all that. So a system to manage it all so that I could kind of play the index in private equity and then private credit. So basically making loans. So to say that, like, I've never really tried to use a financial planner on the public side because I think it's pointless. It's pointless. They don't work for Edward Jones because they're independently wealthy. Okay. They're not geniuses. They're not going to beat the market for you. In fact, they'll probably pull your returns down because they want bonds and annuities and things like that in there that they're going to get a commission off of selling, those insurance products. So to be fair there, I'm trying to play the private equity and private credit index play by wide diversification. Obviously, we don't put 100% of our own investing money, even in our own fund, even though I totally trust Chris. I wish I could just give you all my money. But I just know that from a diversification standpoint is not a smart play. So I'm trying to not beat any indexes. I just like that private tends to beat public if you are diversified enough. So we have a couple of questions here. Let's see. Husband Troy, got a warm body in here asking questions. Appreciate that. Private debt investments backed by physical assets are good SDIRA. They could be, yeah. Chris, do you want to take that? And we have another question here from Ron as well. So would you take that, give it an answer, and then we'll jump over to Ron's question.
Yeah, I briefly read John's question. I think that kind of ties into it.
Mm-hmm.
I mean, just debt investments are good. So, like I said, anything. So, I might have confused the topic. Typically, when you're picking up debt, so there's rules in your IRA account. And it's not all IRA accounts. It's majority of them, though. I mean, you can have a solo 401k where for some odd reason it's exempt. I do not know why. And there's still rules behind that. And you can still get taxed.
It's like,
possibly.
It gets so fiddly.
Yeah, it gets super weird. So definitely consult so if you roll it over, you can definitely consult your custodian, let them know exactly what you're doing, and it can tell you what you're gonna liabilities you potentially can have.
This is educational and entertainment purposes only. Like, this is what we're doing with our own portfolios, not necessarily what you should be doing with yours. But I don't think any advisor would argue against you can't beat the index.
Yeah, just true. I mean, I think even large portfolio managers, I think it's only like 9 or 10%. It's a super small percentage.
It's almost no one.
Of portfolios that actually beat the index
over a 10-year period. Yeah,
over a longer term. Yeah, over a longer term horizon. So you're looking at what types of investments. Again, startups, but again, there's risks that you're taking on as well. So what kind of investments are good? I mean, honestly, it's the investments that you're comfortable with. That's the best investments that are good for your IRA. The other things that you have to take into consideration is, like, again, you can get taxed if you're picking up debt, something called UBIT. So I would definitely look into that. That doesn't make it bad. Again, if you have a return profile, if you invest in an asset that picks up debt and you're getting a 20-30% return, still probably higher than what you would get in the equity market. It just, you got to understand that you're going to pay taxes on it. So I try to keep most of those outside of my if I'm going to invest in it, it's a good investment, I'll probably invest cash. I won't use my IRA for it because I know I'm going to be penalized, and over the longer term horizon I'm still going to get the same return regardless if I use cash or if I use my IRA account. So I look at some of those things. Debt is definitely a good way to go, because if you invest debt on the cash side of it, then it's basically you get taxed as regular income. So there's multiple things to look at, like, how am I going to get taxed? How is it going to grow? Do I have any other tax? Do I have cash to invest? And then ultimately you have to be comfortable with the investment.
Well, I think to Ron's question and kind of Troy's question too, it's your tax situation is going to differ based on what tax perks you qualify for. So Chris, Troy, and me, we're real estate professionals. that means we get to use 100% of depreciation against our active income. Now, anybody can use 100% depreciation against your passive income, against your rents and things like that. But if you want to start offsetting your active income with depreciation, first of all, you need to have some depreciation. Like there's no depreciation in a note, right? So I have some physical assets that I have loaned money to. That income is taxed as active income. I also have physical assets that are equity assets, meaning like I profit share and I loss share, right? So there's no rate of return like there is in a note. And so to me, it's like that diversification there is important, but also for tax purposes. So I want depreciation because that depreciation offsets 100% of the income that I make from the interest on these private loans that we are making. So I make a lot of private loans. If you're in a different situation tax-wise, you may have to consider like, well, I already have a W-2. I'm already getting hammered on active income. You might want to put these debt investments in your IRA so that they're tax advantaged, and then start making more in cash as you're closing in on retirement, because it does take some time to convert your equity from this over here sitting there, equity just growing but unrealized, over into cash flowing investments. And that's what we learned the hard way, is when we're like, hey, we're ready to retire, we hit our FIRE number, and then realized like we didn't have enough cash flow to do it. So we had to spend another couple of years selling assets and converting them over to cash flowing assets just so that we could afford to keep our lights on. So the understanding that there are tax benefits to different situations that you might be in. There's different tax benefits if you're running a short-term rental that you're managing yourself. Most people can't use any depreciation because they make too much money. And so, I mean, any against their active income, they get zero. If you're putting a depreciating asset inside of your IRA, the only thing that depreciation can do is offset some of that UBIT tax or the capital gains the year you sell the asset. So it's not necessarily a bad idea to keep assets depreciating in your IRA. Just understand, like, you're not going to get double tax benefits. You don't get the depreciation and the tax benefits of having it in a retirement account. So everybody's in a different tax situation. I know some people who are using various forms of even oil and gas investments to be able to offset some of their taxes. I don't invest in that yet. I probably will. So I don't know how that works, but just to put that out there, like, there are ways that a good CPA who doesn't just deal with traditional markets can help you be creative about the way that you can save taxes. So whether you do it in cash or a retirement account, it just takes a little bit of math. So actually, Ron, I'm writing an article about whether or not you should cash out your retirement, just pay the penalty. It would be a similar situation if you're going to convert it over to a Roth. If you want to cash it out, try and do it on a year where you're not making as much money, or if that's what we're doing, we cashed ours out. I think we're doing it this year. And then once we cash it out and convert it to, not cash it out, once we convert it to a Roth, we're actually taking it out of self-directed and moving it back into the public markets, because we sold a bunch of our public equities last year and that we had invested in cash in our cash accounts. And now I feel underexposed to the stock market. And so we're converting some of our self-directed back over to some of the public equity. So it can go both ways. You can either convert it to an IRA, self-directed, or even move it back, which is what we're doing. Okay, got a couple more questions here. Yeah. Oh, from Zasha. Yeah, always need to diversify. We diversify. Like, no financial advisor is going to argue with me when I say you need to diversify. The only thing I would say that you wouldn't want to diversify is if, like, your active income, you really want to become a specialist at that thing and really put all your eggs in that active income basket so you can be an expert. But on your passive side, maybe think about investing in things you're not that great at, things you understand, things you know what's going on, but you maybe somebody else is the expert. So that diversification between active and passive is a good distinction. Okay, yeah, that's true. True. Do you remember when we first transferred our Fidelity account over to a self-directed IRA custodian, and the guy at Fidelity told us that we were getting scammed? Like, he had never heard of this before. He really thought that somebody was trying to steal our money. And we had the same thing with the CPA. I went in and I was talking about something about, oh, I'm buying my first real estate investment. I want to get a CPA who can handle it. So he starts talking to me about real estate taxes and things like that. And I remember sitting there thinking, like, didn't I just read an article that those laws changed in like 2017? And here we are in like end of 2018. And I don't think he knows what he's talking about. So, like, you have to be somewhat informed to know if your specialist
That is
is
true.
actually a specialist.
It's not all CPAs or attorneys are created equal. So
True.
going in blind can be very dangerous, even if you're looking for to these professionals for advice. So I would, again, going back, I try to get yourself slightly educated so that
Yeah.
you can so you know when to argue the fact that something just doesn't feel right or something doesn't seem right. um, and if it doesn't, fire your attorney and CPA as quick as you can and find another one, because there
Yeah.
are definitely good ones out there. But there
I
are also
think
ones that are not 100% sure what they're talking about. So,
But they act like they do. So I change every couple of years because I've noticed when I take it to a different CPA, they catch things that the previous one didn't. They all have a different style. Some are more conservative. Some are cowboys. I don't really like that. But every so often, like when there was a CPA shortage, a CPA we really liked and he really knew what he was doing was like, we can't maintain all of our clients, and so we got fired from that CPA. And then so we went to a new one, and he had a completely different perspective. And I was like, oh, maybe I should be switching these up a little bit more often, even if I find an expert, just to get a second opinion or just to get a fresh eyes. And sometimes they'll even file an amendment or addendum, or what do you call it? Amend previous year's taxes and
yeah.
find us more deductions or find us more refunds. So uh, I definitely keep that a little bit on the fluid side, so that we don't get stale and making the same mistakes year after year after year. So because it's so complicated, nobody really, it's like a doctor. You wouldn't let a general like or your obstetrician operate on heart surgery, right? Like you really do need to find a specialist and get second opinions on things.
Yep.
All right. Let's I agree. She's changed CPOs a few times. Yeah. I mean, every single time I change, they want to amend something. Every single time. And I usually they'll get me a refund that more than pays for the cost of the amendment. So all right. Make sure to join us on our webinar coming up. Again, risecapitalinvestments.co/webinar to sign up for reminders there. If you want to get in touch with us, you can get on our personal calendars. I don't know how many people know this. If you go to partnerwithrise.com, we have that link everywhere. But if you do like /our name, you can actually get onto our specific calendar and be able to talk to the person that you really want to talk to, like whether you connected with somebody better or there's an area of expertise or just who knows why, but you can actually get in on our personal calendar and we answer our own phones.
Why people don't answer their own phones.
There's no assistant. Like I think that there's certain things that you can't automate. Like Troy's an automations like tech. That's what he did for his W2 was automations and continuous integration. And so yeah, I get it. Automations, that tech, IT, all that is great, but there are certain things that you just can't farm out to the robot. And answering your phone when a potential investor or somebody wants to
It's
talk
one
about
of
us
those
calls
things.
you, you don't farm that out. Like, there's no assistant. It's us. So we would love to talk to you if you want to jump on our calendar, and be sure to catch us at our webinar coming up. And then also in a month, we'll do another one of these lunch and learn. So every other Thursday, we alternate
All I know
between.
it's a lunch and learn. We'll bring lunch the next time.
Well, they're eating lunch. Have you ever had a lunch and learn at your office and the presenter's
Yeah.
not eating lunch? It's only the people sitting in the audience that
Oh,
are
got
eating
it, got
lunch.
it, got it. Oh, we can eat lunch together. Can be one big happy family. I am excited to hear you and Nate speak in the next few weeks. Again, understand, just trying to get yourself educated. Like, get yourself educated on the different options out there. The more options you have, the faster it is you're gonna be able to get on whatever your wealth journey is. So, super excited for you guys to kind of share and enlighten the group on more options that they can potentially take advantage of.
Yeah. Yeah. And then we'll get you, like I said, that discount code. If you go to the utahria.org, you don't have to live in Utah or be a member of the RIA. There's a coupon code there if you decide to use directed IRA, especially if you've already decided that you want to go with them, might as well go get the
Yeah.
coupon code. So thanks everybody for joining us, and we will see you next time.
All right. Bye, everybody.